Hey Ray, so what do I need to know about getting a mortgage? Other than the interest rate, aren't they all the same? Yes and no. Mortgages are actually a very complicated financial product, but because of the successful experience of millions of people buying houses and getting mortgages over the past 50 years, most people now know what mortgages are. The problem is that every mortgage is actually a little bit different, and the differences are only revealed in the bank's mortgage agreements, sometimes called the mortgage commitment or mortgage approval. And banks don't post these agreements online for everyone to see. You literally have to contact a mortgage advisor or a mortgage broker to get a personalized agreement, which takes a lot of time. So it is actually very hard to shop around and compare mortgages in detail. But there are some things that will be the same no matter who you go with. And one of these things is the interest rate, ironically. You'll be surprised by how similar the interest rates are between different banks. Most banks will even price match against each other, just like the grocery store. But like price matching groceries, most people don't have the time or care to shop around for the absolute best rate, especially when the rates are already very similar. Another thing that's the same with all mortgages is that you can pay back the money you borrowed over a very long period of time, usually 25 or 30 years. This is known as the amortization period. You can even refinance your mortgage every few years and reset the clock for another 25 or 30 years. So theoretically, you could fully avoid paying your mortgage off for a very long time. It's similar to leasing a car. You can just keep leasing a new car at the end of every lease term and never have a fully paid off car. You can also do this with mortgages and never have a fully paid off house. This is obviously great for the banks because it means that they can earn a lifetime of interest from you. In fact, all banks will charge you a penalty called a repayment or prepayment penalty if you want to pay off your mortgage. Every bank calculates the penalty differently based on something called the bank's posted rate of interest. This is a bit too complicated to get into in this video, but just know that the penalty is significant and usually tens of thousands of dollars depending on the situation. At a minimum though, it's usually 3 months of interest, but there is no maximum. Now, there are some exceptions known as prepayment privileges that allow you to pay down about 10 to 20% of your mortgage each year for free. You can also repay the whole mortgage at the end of the term. This is different from the amortization period. Most mortgages have a 5-year term, which means you can pay off the whole mortgage on the last day or the last month of that 5-year term period. This leads to an interesting point, which is that most people only ever repay their mortgage when it comes time to sell their house. And most of the time when they sell, they end up paying the prepayment penalty because the timing of the sale usually does not match up exactly with the end of their mortgage term. And banks know this. So they have already accounted for the prepayment penalty in their total revenue forecast for each mortgage customer. And so should you. Because if you include the cost of the potential prepayment penalty at the end of the term, your total interest paid over that term could be a lot higher than the advertised rate. For example, a 4% mortgage could be 4.5% all in. So some banks might advertise a slightly lower upfront interest rate and balance that by having a slightly higher prepayment penalty. Other banks might charge a slightly more upfront but have a slightly lower prepayment penalty or more prepayment privileges. So if you are looking to minimize costs, you need to consider both the upfront costs and the back-end costs of paying off your mortgage. The last thing that's also the same across all banks is what happens when you can't pay your mortgage, i.e. when you default. Here in Ontario, Canada, if you fail to make your mortgage payments, the bank can evict you and sell your house without your permission. This is called the power of sale. The bank will then use the sale proceeds to pay itself back plus expenses. And if there is not enough money from the sale proceeds to pay back the entire mortgage, the bank will continue to sue you for the balance even after they've evicted you and sold your house. Now, most banks will not immediately go from default to selling your house. They will allow you some time to make up the missed payment, and of course they will charge you penalties, including legal fees along the way. So similar to a prepayment penalty, you also have to consider default penalties, also known basically as late fees, as part of your total overall cost of carrying a mortgage. Because defaults do happen, even if it is only 1% of the time, that's millions of dollars for the bank. And there is a whole industry of lawyers that just do mortgage enforcement. Mortgages are complicated and they involve a lot of costs. The main component is the interest, but there is also other prepayment penalties and other costs that make up a lot of the revenue for a bank. The advertised interest rates and other features of a mortgage will be about the same across different banks because there's competition. But at the individual level, if there's a chance that you might have to sell your house before the mortgage is paid off, or if you run into some financial issues and miss a few payments, the total cost of your mortgage can increase quickly. And the chance that one of these happens to you is not zero. So it needs to be a factor when you are considering getting a mortgage. So Ray, are all mortgages the same? Yes, most mortgages are very similar in many ways, but your personal situation can make a big difference. That's why you need to take the time to consider the entire process, from getting a mortgage up front, maintaining it over a long period of time, and eventually paying it off. I'm Raymond Diep. I'm a Canadian real estate lawyer, and this was episode 4 of the Deep Dive with Deep Law. Thanks for watching.